Welcome back friends to the class 27. In the previous video we have discussed the total outline of the financial eligibility of the borrower, in which we understand that there are multiple different products. So there are product specific guidelines with respect to how to calculate the financial eligibility, and there are some internal regulations of the bank that can also impact the final financial eligibility decision, right? So now we have to start by understanding the working capital products, why their assessment is based on the investment part, the balance sheet part. We will try to understand each and everything in minute details so that you can understand the whole concept deeply, right? So in the previous video, we had discussed that the working capital loans assessment are based on their MPBF, turnover method, working capital gap, etc. Then it is again limited to the drawing power and operating cycle. Some of the products have their individual assessments, and there are different types of working capital products that I have mentioned here for your understanding, right? So we will be covering all meaning of all these different working capital products along with all these methods of assessment. So in this video, first we have to understand how the end use of the working capital is determined by the bankers, and why it is based on the balance sheet part of the borrower, right? So the working capital word is made of two words: working and capital. Capital means money. Capital simply means money. Working means daily working needs of the business. So working capital means the money required or the money needed or the money used to meet with the daily working needs of the business. So the money used to manage the day-to-day operations of the business is called the working capital. And what do we mean by the daily working operations of the business? What are the expenses that are incurred on daily basis or on regular basis in the business? So some of the examples are payments to the supplier for purchase of raw material, salary payments, electricity bill payments, repairs and maintenance, travel expenses, interest payments, rent payment, insurances payment, taxes payments, selling expenses, advertisements, business promotions, transport expenses, etc. These are the daily and routine expenses of the business that are incurred, right? So all of these expenses are paid by the business, so they need money to for payment of these expenses, and the money that is required to pay these regular daily nature of business of expenses are called working capital. So why the assessment or why the need of the working capital is based on the balance sheet part? Let us understand this. Friends, this is a profit and loss account format in front of you. The profit and loss account starts with sales and the closing stock. Sales and the closing stock. Here, these two are, the basic thing in the business. Sales is the income and closing stock is the inventory left at the end of the year in the business. This is the opening stock, purchases, all the direct and manufacturing expenses are clubbed in this. And then we comes to gross profit, that is the profit that is made on the production of goods. And the same gross profit, which is the balance left, is brought down here. And then all other remaining expenses which are not directly contributing in manufacturing of the product are clubbed here. Then we then we are left with the net profit part. How much profit at the end is generated by the business after spending all on expenses? This is net profit, right? So friends, if we see this profit and loss account carefully, then if you allow me, then I can erase the gross profit from here and here. This will not impact any of the total impact or net profit of my business. Since the gross profit entry has crossed in both of these sides, first time here and the second time here with the same amount, and even if I erase the gross profit entry, then there will not be a slight single rupee difference in end-to-end net profit of my business, right? So if I further do some calculation, I will erase this, first this total side, right. So this is my combined profit and loss statement, which looks like this, right? So the total here matches with each other. The total here represents the total of all of this side, and the total here represents the total of only these two items, right? And both of them tallies with each other, right? For example, the sales is 10 rupees, stock is 1 rupee, then this total is 11 rupee. Suppose opening stock is nil, purchases are 5 rupees, direct expenses are 2 rupees, this is 1 rupee, then 5 plus 2, 7 plus 1, 8, then net profit is 3 rupees, which is the balance left. So the total is 11 rupees here as well, right? So the total of both sides matches with each other always. So if we friends see carefully, all this total of 11 rupees, all this total of 11 rupees, which cover all expenses, all expenses are added in this 11 rupees, plus it covers the profit as well. It covers the profit as well. It 11 rupees include the 3 rupees profit as well. All of these 11 rupees are distributed among these two only. All these 11 rupees are distributed between these two only. And moreover, if we see this 3 rupee profit, this 3 rupee profit is included in 10 rupees sales only, because whatever you profit you generate by actually selling the goods. So this 3 rupees profit is included in this 10 rupees sales and not in this. So this amount is only a cost. This represent only a cost, and this represent, out of this 11 rupees, this represent 3 rupees profit and 6 rupees cost. Am I right? This represents 3 rupees profit and 7 rupees cost, and this represent only 1 rupee cost. Am I clear? Friends, if we see here, these expenses are those expenses that I have mentioned here, for which you need the working capital. These are the expenses which are incurred by you on daily basis, on regular basis in the businesses, right? For to manage these expenses, you need working capital. And all of these expenses are somehow merged in this and this, including the profits. But friends, when I say you need to pay for these expenses, I mean you have to pay hard cash when you actually make the payment. Whenever we prepare a profit and loss account, it is prepared on the principle of accrual concept, when the expenses are matched with the incomes. For example, for example, a client has purchased raw material of 10 rupees, right? And he has to make payment of 10 rupees for purchase of this material. So in profit and loss account, the purchase of 10 rupees will get reflected since the material is purchased. But if the client has not paid the 10 rupees amount to its supplier, then that means these 10 rupees are still payable by our client, and these are not actually paid in cash as of yet. These are not paid in cash as of yet. So if we study only these expenses, we will get confused. We will say that all these expenses are paid in cash, but there can be a situation that some of these expenses are not paid in cash by the client. Some of these expenses are not paid in cash by the client. And how do we know how much expenses are not paid in cash by the client? So for that, we will have to see the creditors figures, creditors for goods and creditors for expenses. These represents the amount of expenses as on 31st March, because balance sheet is always prepared on last day of the year, as on 31st March, which are still not paid in cash. Still not paid in cash. That means That means this much of a payment, whatever amount is, for example, it is 3 rupees. It is 3 rupees. Then these 3 rupees represent that client has not paid these 3 rupees in cash as of yet, right? So if his expenses are 3 rupees are the profits, and that means his expenses are only 8 rupees. Only 8 rupees, na? Out 3 rupees are profit and expenses are 8 rupees, thus total is 11 rupees. So out of these 8 rupees, 3 rupees are not paid. 3 rupees are not paid. That means 5 rupees are paid. 5 rupees are paid. So this is the actually cash outflow. This is the actual cash outflow. So you will say, sir, sir, this position is of the 31st March only, and these expenses are for full year. How do we know that how much amount client amount was actually payable on supposingly on 31st December, on supposingly on 27th of October? How do we know that? We cannot know that. We don't know that. So there is always a presumption in working capital finance while lending that whatever amount of creditors, debtors, or creditors or debtors is appearing, or stock even, or is appearing on 31st March, this is the same amount that remains outstanding on an average throughout the year. This is the general presumption done by the lenders before finalizing the working capital decisions, unless and until you prove otherwise to them. Unless and until, right? If you don't prove otherwise, they will presume that the figures of creditors and debtors that is reflected on 31st March is the same figure that prevails throughout the year. I know that this is a very vague assumption, but this is a fact. Banks don't have any other option to know what is the average actual outstanding throughout the year, right? Bank cannot access whole of your everyday record. They have only profit and loss account and balance sheet to assess and presume about your position. If this position doesn't report actual picture of your business, that figure is based on only 31st March data, it may not be reflecting true picture of your business, then you have to prove otherwise to the bank with documentary evidences, right? So out of these 8 rupees expenses, 5 rupees are actually paid. This is the cash outflow. This is the actual cash outflow which the bankers thinks in their head. So now this closing stock of 1 rupee expense that comes here, in stock angle, right? And the sales that you have done to your customers of 10 rupees, that 1 rupee stock is already, we know that it has not been recovered. It is non-recoverable. The sales here of rupees 10, there may be a situation that you haven't received all this amount in cash from your client. There may be a situation that out of rupees 10, you have only received 8 rupees in cash, or suppose you have only received 4 rupees in cash, and rupees 6 are still pending to be received from them. So in here, rupees 6 shall be shown as pending to be received. This 1 rupee will show your investment in stock, which is not realized yet, which is not sold yet. But this is your investment. So this 6 rupees, that you haven't received from your clients, this represent your investments only. That you are not able to recover this 6 rupees from your clients, and the bank will presume that these 6 rupees remain outstanding from your customers throughout the year, that these amount remain receivable throughout the year. So these 6 plus rupees 1 is the 7 rupees investment done by you for all of these expenses and profits. So all of these expenses and profits, these 7 rupees has to be invested by you. They are not recovered. These are not recovered by you from the clients. You have lent them on credit, and you have invested rupees 7 to them out of these 11 rupees. But out of these 11 rupees, 3 rupees you haven't paid you haven't paid to your suppliers as well, suppliers or your service provider or whatever the expenses are. So out of these 11 rupees, you are saying on here that 7 rupees are my investment. I am the 7 rupees are my investment. I have invested 7 rupees out of 11 rupees. 7 rupees I have invested out of 11 rupees. You keep on saying that, but on the liability side, these 3 rupees represent you haven't paid these 3 rupees to these suppliers as well. So in nutshell, we will say that 7 rupees you have invested, 3 rupees you haven't given. So in nutshell, you have given 4 rupees, or you have invested 4 rupees to manage your business, to manage your business day to day operations, right? These 4 rupees are part of this profit and loss account only. It may include some a bit 0.5, 0.7 rupees profit as well, but rest assured, rest of it is only the cost. Mostly it only the cost, right? So these 4 rupees actually represents the amount of net investment that you are doing in your daily, day-to-day expenditures. And these 4 rupees actually represents the money that you need for investments in your working capital. So that is why the end use of the working capital is assessed from the balance sheet angle only, and it is not possible to assess it from the profit and loss or income side of the borrower, right? So this is the concept that I wanted to explain to you in this video. I hope you have understood it. If you have any query, then you can put up a comment. I will revert to it, and we will meet in the next video. Till then, thank you very much.